Dubai's real estate landscape has been in the headlines since the Emirate stunned the world with its speed and innovation in development. And now, with Dubai to host the Expo 2020, the property market here is once again in the spotlight. We sat down with Jessie Downs, the Managing Director of Phidar Advisory, to talk about the firm's latest findings about the market. It was a night to remember when Dubai was announced the host of the World Expo 2020. Since then, the initial buzz has subsided, but now the drive is clearly being felt throughout Dubai's trade, tourism and hospitality sectors. Meanwhile, Dubai's property market is also set to benefit from the underlying economic expansion prior to the event. The real estate market here has always garnered a lot of attention around the world, both in its fast-paced development pre-2009 and now with its resilience, having bounced back from the GFC. So what is it about Dubai's property market that continues to attract investors?
Well, first, Dubai is a regional hub, and I think we can all agree on that. But it's also a very important bridge between two areas of significant growth, and that's Africa and Asia, and solidifying its position more and more, and we expect that to continue in the years to come. In addition to that, Dubai also has put in place certain policies, infrastructures, and systems that make this an attractive place to live and work. For example, it's considered a very safe and stable environment and offers a very high quality of life.
Phidar Advisory, a recently established advisory firm specialising in real estate in the UAE, has said the Emirates' economic growth could be as high as 5.6% this year, and even if the global economy slows, Dubai has enough momentum to sustain its own expansion. Can you explain, in comparison to other global markets, what types of investments are offered here, and do they represent good value?
Well, it really depends on what perspective you're looking at this market from. As we know from the Dubai Land Department, the largest buyer of Dubai property is Indians, and in their home market, it's very common to see yields of 2 to 3.5% approximately in key urban areas. So when you look at Dubai's current yields of 4.5 to 6%, it is attractive. But when you look at, for example, the second largest buyer of Dubai real estate, which I believe is British nationals, the story changes slightly. So in London Prime, we all know the yields are quite low. It's approximately 2 to 3% in some for key assets. But London overall is closer to 6%, and UK average is between 6 and 7%. So the value story changes. So it really depends on what perspective you're coming at this market from.
For a potential investor looking to enter the market, what are the types of things they need to be considering?
Okay, firstly, you look at the developer. And it's not only what they're selling you today. I encourage everybody to look at the track record. And what that means is look at their existing projects and start asking yourself, have they delivered on time? Have they delivered the quality and specification they promised? For example, a lot of properties are marketed as luxury, but was luxury genuinely delivered? Were the specifications delivered? Were the communal areas that they promised delivered? And then how well is the overall asset managed? Granted, this eventually gets handed over to the Owners Association, but in the first year there's a transition period, and in that period we also expect to see snagging. So that's the fixing of the problems that occur while the property is under warranty under its first year. How does the developer handle that? Do they respond to homeowners in a quick and prompt manner and then resolve the issue accordingly, or is that less than adequate? Then you have to look at the overall area and the master development. So how is the master development being managed? What's the quality of the original design as well? What is the infrastructure in place? And if it's not already all in place, the infrastructure, what is the master developer's track record at completing infrastructure? And there's a wide variety of quality on both accounts for both developers and master developers. You see some master developers that are very good at delivering on their promises. It might not be in the exact time frame that they promised, but it's more or less acceptable. And the quality is as you would expect. And others, it's not so consistent. And that is very important for a property. Basic infrastructure is critical. So how the ease of getting to your property will affect the price and the rent that you can get for that property. later on. And there is no guarantee that a master developer will finish an unfinished project. So you really have to look at their existing track record. So I'd also look at the overall location and consider, is the product you're buying suitable to the surroundings? For example, if the area you're buying in or considering buying in is generally populated by middle-income residents and middle-income housing, and you're looking at a luxury project, it might not be a good fit, and that might not be the product quality that eventually gets delivered. Of course, there's no hard and fast rule to that, and there are always exceptions, but it's something to consider. Another point to consider is the local regulation in the market dynamics at the time. So as we know, there are certain monetary policies that are cooling the market right now, and it's a very good measure in my opinion, but that makes the trajectory for some products different. So when you look at certain policies that affect or restrict mortgages, for example, it can have a bigger impact on the pricier assets, for example, single-family homes. So you really need to consider multiple variables in this equation, from the developer track record to the master developer to the overall location, the policies, the market dynamics. So what we found was in the first half of 2014, prices were still rising. That's not a new story. We expected that. But in Q2, we saw that increase slowing down. And then in the first half of Q3, we saw price contraction, particularly for single-family homes. They contracted by 4% and apartments contracted by under 1%. But that's to be expected because the recovery of apartments lagged the recovery of single-family homes by about 2 to 4 quarters. So it's not really surprising that they're not completely in sync. And also, I've mentioned the monetary policies that are cooling demand through limiting certain aspects of mortgages, and that will have a more immediate effect on more expensive properties, which tend to be single-family homes on a square foot, or on an not on a square foot basis, but on an overall price basis, as total cost. On average, like for like, comparing quality, single-family homes are more expensive than apartments, so we would expect that. We also found that yields compressed to about 4.5% for villas or single-family homes, and roughly, I believe, 5.6% for apartments, which is quite low. It's really compressing. When you look at it versus other investments and their return, we're starting to see that stretching too far. And I think that's also leading to the price decline, as we need to allow rents to kind of catch up and offer a better yield and therefore a better return for investments. So I think the reason for this is because we saw an overexuberance of expectation after, even before the Dubai was awarded the Expo 2020, and then of course immediately after that continued, when the real impact of that will only be felt in 2018. For example, when you look at the supply and demand, based on a 3-year outlook, supply is growing at about 4% on average each year, and demand is growing at about 3.7%. So supply is slightly outpacing demand. So we should see, if you look at the fundamentals, we should see the market being relatively stable over this time period. So I think the price correction right now is bringing us back to that stability. But then the story changes when you look on a 5-year basis. The supply is growing at an average of 3% and the demand is growing at an average of 4%. So you see demand outstripping supply. And this is because we'll see the impact of Expo 2020 really in 2018 onwards. So what we're seeing right now is very healthy and very much needed in the market. But again, I cannot reiterate enough. Long term, the fundamentals are still there, so this really should be a correction and not a price free fall that we saw, for example, in late 2008 and 2009.
There are a number of high-profile developers announcing projects for Dubai, all of which are attracting an endless amount of buyers, particularly for off-plan sales. With investors keen to own property in the emirate in the build-up to the Expo, how important is the previous track record of these developers in contributing to the success of these projects?
Developer track record is absolutely critical. When you're purchasing an off-plan property, you're not purchasing the same product as a completed property. I know that might sound like an obvious statement, but when you look at the numbers and the returns in a hot market, and where the differential between completed and off-plan starts to shrink, which we have been seeing in the last few quarters, it implies that people are forgetting that rule of thumb. So when you're purchasing an off-plan property, you're purchasing the promise of a delivery of a certain product to a certain specification at a certain time. And as we know, it almost never happens precisely to that specification, that timing, but it should happen more or less to those specifications and timings. So you're absorbing that risk, and that is a significant risk when you're looking at a market with a widely varying quality level in terms of both product quality, but also the timing of delivery. So I cannot stress this enough. You have to look at the developer's track record. And while we did learn a lot of lessons in 2008, 2009, the trends that we've seen over the last 2 years to some extent are starting to indicate that we might be forgetting those trends. But I think the correction that we're seeing right now is bringing that to is because people are remembering this lesson, and hopefully we'll avoid a bout of irrational exuberance that we saw in 2007 and 2008, and will correct the mean and continue on a stable trajectory.
Finally, your report states that you believe long-term that Dubai's supply of affordable housing for middle-income expatriates will not keep up with demand, increasing undersupply by the end of 2018. How should this be addressed, and what effect will this have on Dubai's economy?
First of all, the impact will be significant long-term. A lot of these impacts are more difficult to quantify, so they go unnoticed. The easiest to quantify is the direct impact on businesses, because as housing costs increase, it's felt directly by businesses. This is an expat-driven economy, and that cost is not completely directly passed on to the employer, but relatively more immediately felt by the employer than in other markets. And so it increased business costs, which slows down the pace that businesses can grow at. So ultimately, there is a natural brake that it puts on the economy, and it's cyclical. In the end, it has an impact, and it will be a negative impact. Now, there's other factors that are more qualitative and harder to quantify, and that's on labor productivity. So if you have the majority of your labor force under this strain of a lack of suitable housing, they're going to be looking at alternatives. In other words, like sharing housing, or they're going to be relocating to outlying emirates. To rectify this situation, what we really ideally need to see is government policies that facilitate the development of middle-income housing. Usually a different structure is needed because you're not selling these units off-plan, ideally, and there's different structures that you can pursue, but ultimately what it comes down to is finding land at an appropriate price and managing the costs of developing that. And so ideally we need to see some policies that help manage those costs. In other words, we've seen similar policies for 2- and 3-star hotels. Let's create similar policies for middle-income residential housing. I think that would be quite helpful.
Well, that brings us to the end of our program. If you would like to know more about any of the stories you have seen tonight, you can contact us at UAE Weekly at city7tv.com or by calling us on 04 367 2230. From myself and the entire team, have a great week ahead.